Hello, my name is Desmond Wolstenhume, and I'm a credit analyst for Western AgCredit. I have been with the company just shy of 3 years. I work out of our Spanish Fork branch office, and I work with our branches from all over the association. Today, I am going to be talking about the 5 C's of credit. So, Western AgCredit, as well as all other lenders, use some form of the 5 C's of credit during their underwriting process. They use the 5 C's of credit to represent different components of the decision process when they're analyzing and what actions they want to take when they receive a loan request. All of different lenders consider one or many of the C's to be the most important. A lot of that is relevant to the culture of the lending institution, as well as the person doing the analysis. However, all 5 of the C's are very important. The 5 C's that we will be going over today are character, capacity, capital, conditions, and collateral. So the first C that we're going to discuss is character. Every lending decision requires an answer to the basic question: is the customer of sound character, and do they have the management ability to run the operation and repay the loan? Character is a huge C in my book. I consider character to be very important. One of the things that I like best about working for Western AgCredit is the fact that we get to work with farmers and ranchers. I think that farmers and ranchers have the highest character of all those people that you will work with. That's why I love what I do and who I get to work with. As stated in this slide, the character factor is often regarded as the most important credit factor. This is because it's the catalyst that transforms expectations, goals, and projections into reality. It's imperative that the lender collects the most accurate information and performs the best analysis possible. As I stated earlier, it is important that all 5 of the C's of credit are balanced and that the association understands all 5 of them. For the purpose of the lending decision, character is defined as the customer's willingness and determination to repay the loan, regardless of unseen adversity. As many of us know, within agriculture, there is often unforeseen adversity. This can be related to weather, to drought, to pricing, to market, or as recently we saw, the effects of COVID-19. Character involves such qualities as honesty, openness, integrity, and self-discipline. In general, sound character should be viewed as a necessity, but not the only condition for acceptable loan performance. One of my favorite quotes that is related to character goes as follows: "People with good intentions make promises, but people with good character keep them." The next C of credit that we are going to go over is capacity. Capacity refers to the customer's ability to generate sufficient earnings to repay their obligations. These obligations can include many things: their current obligations, to repay any new debt, plus cover family living, capital replacements, and any other adversity that may come up during the year. As seen in the slide, earnings capacity is not the same as cash flow. When we are going through the underwriting process, there are adjustments that are necessary to make to the financial statements. Accrual adjustments need to be made to cash income to accurately determine net income or earned net worth change. An operation can have sufficient cash flow to meet current obligations without always having a positive net earnings. The reverse can also be true. The first use of net income is to cover withdrawals for family living. The remainder is then used to cover or repay capital debts or buy new assets. Income not necessarily for these purposes is then available to expand, invest, or build a reserve. When we are discussing capacity, it is important that we understand both historical and projected cash flow and income statements or earned net worth changes. It is important to look at historical capacity as well as what is projected. In conjunction with that, it's important that we take time to sit down with you as a borrower to understand what your projections are. Over the longer term, repayment capacity margins must be sufficient to cover occasional operating losses and unforeseen expenditures. The risk associated with the capacity factor is closely associated with the capital factor, as we will discuss next. As the risk of low or negative capacity margin increases, a correspondingly stronger capital position is required to offset that shortfall. The next thing we are going to talk about is capital. Capital refers or is in conjunction with the entity or individual's balance sheet. An evaluation of the capital position typically involves an analysis of the financial progress, asset quality, working capital, liquidity, solvency, and debt structure. The analysis of these factors involves historical and current balance sheet as well as incapacity. It is important that we have evenly timed dates so we are able to use those accrual adjustments as I stated earlier, and that we are able to track the changes in net worth. Part of the analysis of capital is determining if the customer's financial position has improved or deteriorated over time. Whether we are considering the past, present, or projected financial statements, it is important that we understand those values. When we are discussing capital, there are ratios that we are going to discuss and need to understand. There are several formulas that may be used. The first is related to liquidity. The two liquidity ratios that we typically look at are working capital and current ratio. The first is working capital. Working capital is the current assets minus current liabilities. Working capital is the amount by which the customer's current assets exceed current liabilities. Working capital is crucial because it is what is currently owed and needing to be repaid. The second ratio is the current ratio. This is the current assets over current liabilities. As an example, a current ratio of 2:1 indicates that the value of the current assets could decline by 50% before liabilities would exceed liquid assets. A current ratio of 1:1 or less indicates the potential for serious liquidity problems. When we are doing an analysis, we also look at how long your current assets could cover your monthly expenses and debt service. Another key point that we look at is solvency. Solvency is a crucial measure that many lenders will look at. 3 measures of solvency that document the relationship between total assets, total liability, and customers' owner equity are as follows. These are debt to equity ratio, debt to asset ratio, and owner equity ratio. The formula for these are as follows. The debt to equity ratio is total liability over owner's equity. This is also known as the leverage ratio. Debt to asset ratio is total liability over total assets. A debt to asset ratio of over 50% also means the creditor have a greater claim on the business than does the producer because you have more debt than you do assets. The owner equity is just the opposite of this. It is total assets to total liability. An owner equity ratio of greater than 50% means that you as a producer has a greater share of the business than does the creditors. The next C that we will look at is conditions. After an analysis is completed, we will set conditions that are in line with the analysis that we have completed. It is crucial as a lender that we explain these conditions to the borrowers, and it is also just as important for the borrower to understand what these conditions are so that they can remain in compliance. The lender has direct control over these provisions such as loan amount, use of funds, and loan terms. The lender is responsible to make the amount and purpose of the loan constructive and to establish repayment terms that are practical for all parties involved. Just as the Western AgCredit mission states, we are working towards providing the most dependable source of constructive credit. One thing that is super important to us at Western AgCredit is that we are providing constructive credit. We want to be able to help the operation and for them to continue to grow and achieve their goals. By providing constructive credit, we are able to do so. That's why conditions are key to when we are setting up a loan so that we can structure it as such that the operation is able to be successful in the long term. The primary purpose of a loan is to improve the income and financial position of the applicant. Just as stated before, conditions should support the analyst's recommendations for the loan after the analysis of all credit factors are considered. When we are considering the conditions and determining the loan amount and the structure, the amount must be adequate to serve the applicant's needs, yet be reasonable in relation to supporting management skills, repayment performance, financial responsibility, and collateral. Just as stated in other slideshow presentations, the loan term should not generally exceed the economic life of the project or the asset being financed. When we are structuring the loan, we want to align it with the operational structure. Depending on what type of operation you have, it will determine how often you can pay, when you can pay, and what debt service you are able to have. We want you to be able to repay the loan and protect your collateral without interrupting normal operations of the applicant's business. There are 3 things that we can look at in regards to conditions, or when you are applying for a loan: necessities, needs, and wants. Essential requirements of the operation are considered to be necessities. These must be provided for before credit is extended for any other purpose. These are the crucial things that your operation needs to survive day to day and to operate efficiently. Needs are not direct costs of the operation, but are ordinary expenses that are ultimately paid for from operating income. The last thing are wants. Wants are things that the customer can get along without that does not necessarily contribute directly to profitability. The operation may falter and the loan may deteriorate if excess credit is provided for wants, and doing so might preclude the extension of additional funds to meet necessities as they arise. It is not always saying that we are not able to finance wants of the operation. It is just crucial to understand if those wants are going to provide long-term viability of the operation and increase profitability. The last C of credit that we will discuss is collateral. Collateral are the assets that as a lender we are going to take to ensure performance of the lending agreement. In some relationships, the collateral is the primary source of repayment for the loan, while the other lending relationships, collateral is the last line of defense for the lender to avoid taking a loss on the loan. As I discussed earlier when I introduced that all lending institutions use the 5 C's of credit, some look at collateral as a primary source of repayment, whereas others look at it, as I said, a last line of defense. At Western AgCredit, we like to look at collateral as a last resort. We want the operation to be able to service their debt requirements from everyday operations instead of selling collateral to repay that. This ensures that the operations have long-term viability and are able to reach their goals, again relating to the fact that we want to provide only constructive credit. There are 3 types of collateral that Western AgCredit will take. The first is personal property. Personal property is typically described as any tangible, movable, or immovable property other than real estate. This can include cattle, equipment, and many others. The second is real estate, physical land and appenditures affixed to the land. This form of collateral is generally associated with long-term financing, but is also used with short-term loans as well. The last is real property. This is all interests, benefits, and rights inherent to the ownership of the physical real estate. This could include grazing rights, water rights, etc. There are different types of collateral. We usually break this into short and intermediate term loans as well as long-term loans. Short and intermediate term loans are primarily secured with a first priority interest on personal property. These loans may also be secured with a first priority interest in real property. As stated in another set of slides, PCA typically combines all collateral into one pool and will secure all PCA loans. Long-term loans are typically secured by first lien or equivalent interest in real estate property. Again, we want to align the life of the collateral with the life of the loan. In conclusion, I want to thank you for taking the time to work through these slides and learn a little bit more about the 5 C's of credit. The 5 C's of credit are the basis of how we determine and analyze a loan. Thank you.